Really, what does that do? That brings us right back to Basel III. And, you know, we haven't talked about that for a while, but and there's a lot of misinformation out there right now. And as we've drawn attention to previously, other than this 6-month extension granted the LBMA local London markets, every jurisdiction, including the COMEX, is already Basel III compliant. Now, in so much as they adhere to NSFR rules. Now, the back door that actually perpetuates the continued gaming that we are seeing is the related 6-month extension. The LBMA unallocated gold markets were given to become compliant. Now, as we've highlighted previously, due to global competition from primarily the BRICS countries backing up their respective currencies with physical gold, ultimately the Eurozone and the BIS will benefit from and indeed will require a stronger gold price to protect their rapidly depreciating dollar holdings. Now, the issue we're running up against into this rapidly closing window is that until then, these over-the-counter unallocated long so-called hedges that we were talking about are accepted by the CME and the CFTC as a COMEX short position offset, which essentially allows the Basel III compliant COMEX market to continue as a paper market. And due to the fact that these offsets through are accepted, but they're not physical. But that's going to change on the 31st of December.
Now, Andrew, just before we started recording today's episode, you were talking about the mechanics of a gold market revaluation. Can you just update our subscribers on this whole concept, please?
Yeah, Shane, that brings us right back to this, as you say, gold revaluation discussion. And as we know, look, the Fed doesn't hold any gold. It holds gold certificates. The certificates are issued by the Fed, to the Fed by the US Treasury, who claim to hold these, well, unaudited physical reserves. Ask Moody, who wrote to the Fed and asked for a disclosure, never got a response. But I mean, hey, this is supposed to be unaudited physical reserve. But this relationship, so leaving aside that this is probably rehypothecated, this is a smoke and mirrors relationship. So even if you accept that that was there and not rehypothecated, which I honestly don't believe it is, I believe it is rehypothecated, by revaluing the 8,133 tons of gold held by the US, it's at currently 11 billion. It allows the Fed to have a paper claim on all this gold at $42 an ounce. Now, gold's been revalued twice in the last 100 years. The first revaluation was in 1934 when the gold price was repegged from $20 and a half bucks to $35, effectively increasing the gold on the Federal Reserve's balance sheet by close on 70%. And this increase in assets allowed the Federal Reserve to further inflate money supply. Hey, does that rhyme with anything right now? And the second revaluation was in 1973. That was 2 years after Nixon safely ended the convertibility of the dollar to gold. So if the Fed was to mirror this previous close on 70% gold revaluation, it would raise the $42 price to over $70. But based on today's price, technically this would force a treasury price of about $3,200. And that still looks far too cheap to accommodate Basel III's NSFR, which will morph gold credit positions into a cash settled, physically settled marketplace. Now the question now is, with Basel III about to value physical gold as real cash equivalent, is it time for the Fed to revalue gold certificates to market to accommodate trillions of dollars of money supply and simultaneously to protect the dollar hegemony? Now, if gold was valued at 1900, close to where it is today, the Fed would only have a claim on just a couple of tons, like maybe 18 tons of this 8,000 odd tons of US gold reserves. Now, obviously, this is an inside arm's length agreement that currently insulates the Fed, allowing them to maintain monetary control without the danger of political interference. Insulating gold from its real price keeps the power in the Fed's hands, for now, negating the likes of Macron in France, who's trying to currently sell gold reserves for political reasons. So let's not forget that the whole objective of NSFR is to force banks to finance long-term assets with long-term money to avoid liquidity failures that threatened the entire banking system following the 2007-2008 global financial crisis. Now, given gold derivatives comprise some 70 trillion of interbank counterparty risk, there's just no going back from this directive. It's too big. And there's a lot of differing opinions on the impact that these standards will have on the gold price. Every negative spin we have seen or heard results from these changes being viewed through the lens of this 50-year cash-settled legacy market. People are in the casino. They don't look outside it. Namely, it is the price benchmark against the COMEX cash-settled futures market, which was born out of necessity, as you say, 3 years after Nixon closed this gold convertibility window in 71. So in 1971. So the problem stems from the fact that the LBMA and the World Gold Council and the current legacy system does not differentiate unallocated gold from allocated gold. Sorry, but we have to briefly dig into some technicals here, because what it revolves around is the argument revolves around the published basis and co-basis data, which determines how the GOFO rate is set. And so the difference between basically LIBOR and the gold lease rate. And this reflects the paper to physical anomaly really well. And by adding or reducing undeliverable gold open interest, officials governing the price of gold against the dollar have tricked the legacy market players into benchmarking their trades upon it. And it's also the basis for those who argue that Basel III will be bad for gold. And for the last 50 years, as you allude to, Shane, one unallocated gold market has been used to hedge with the other. And it's quite evident that the LBMA's begging letter that we saw a few months back, where they managed to get a 6-month extension, was really attempting to argue the toss that this risk weighting perspective, that these high counterparty risk unallocated gold positions clearing 600 odd tons of unallocated gold a day should, under Basel III standards, not be segregated from the 1 ounce of cash equivalent tier 1 physical gold that underpins the high counterparty risk 100 to 1 unallocated gold position. So while Basel III global compliance has been extended, it is not the case for gold. So a lot of people have said, yeah, it's been extended a few years out, not for gold. Raising funding requirements for unallocated gold means a financial institution would either reduce or exit the bullion business. And if you remember, the Bank of America said at one point, what it's going to do is sustain activity and put more funding aside. However, that argument, so yes, okay, so the argument is you could do it, you could fund it, you could keep the game going. But excuse me, then it becomes bloody expensive, and it's going to reduce an awful lot of liquidity if you have forced to roll those things onto your balance sheet. So look, we could look in more detail about it, but look, if rising costs for market participants is going to be determined by the cost of financing precious metals production, but without incurring counterparty risk. So this simply means that the cost of such financing will have to rise to the extent that these forward transactions can be backed by real hedged physical gold. And all this means is that the end user price of physical gold will have to rise to meet this cost. There is absolutely no requirement to see 1/3 of all mine production cleared and hedged in London every day. The volumes of gold cleared every day will dramatically reduce. So this is a good thing for the gold market, as paper dilution will dissipate and a true physical price demand price will ultimately emerge. Now, equally, there's no requirement to see 9,300 tons of joined at the hip silver cleared amongst the LBMA members every day in London. So really,